Thank you for joining us today for PEG's first ever live webinar. We appreciate your time. We're really excited to share with you some of the things that we've been thinking about. And we do want to thank our guest speakers today. We find ourselves in some very unprecedented times. And amidst all of this global pandemic crisis, there's an issue that has been particularly affected and continues to be in effect, and that's the affordability of housing in the United States. Even before COVID, we found ourselves talking about affordable housing, and with unemployment levels at historical highs, we are concerned about the low-income renters in particular and the types of options that they have for housing. So as as PEG companies, we think about this a lot. We look for market opportunities, but we also want to bring to market things that are of value, and if we can, do some good in the world. So today we're going to be focusing on this housing affordability crisis. We're going to hear from some experts. We're also going to talk about how PEG is addressing this specifically and some of the creative solutions that we've been able to come forth with. So to start this all off with, I want to introduce Gunther, the founder and CEO of PEG Companies, and he's actually going to specifically talk about some of the things that we are doing to address this very important need. Cameron?
Rachel, I'm so excited for the opportunity to address a strategy that is generating a lot of interest right now. I want to start with a little context about the strategy. It is known in the industry, both with the investors and brokers, even the brands, that PEG has embarked on a strategy to acquire extended stay properties, to convert them into multifamily, to really hit the affordability issue in a lot of these cities. In 2017, early 2017, we were doing a project in downtown Boise. We saw a new Residence Inn by Marriott being built within a mile of an existing Residence Inn that was older, built in the 80s, that really looked like an apartment complex with 8 plexes, and it was really extended stay for people to live there short term. It was in an area that we thought was great for multifamily, so we approached the owner to see if we could buy it and do the conversion to multifamily. We were unsuccessful, and because of that, we went back to Marriott and said, look, these guys have got to have more Generation 1s in their portfolio, so let's see if we can get a list from them. In July of 2017, they provided us a list of all their Gen 1s, and we took that list and went through it and tried to find potential sellers. Over the last 2 years, we transacted on about 13 of these extended stay Residence Inns with Blackstone. And in the process of doing that, we also noticed that it's not just the Residence Inns, there's other brands that also are extended stay that can be converted. Now, one of the things that's really important for us to understand, and as we look at this affordability issue, is in order for somebody to go build a new Class B or Class C property with construction costs as high as they are, they have to either get tax credits or public incentives. The nice thing about the strategy that we're pursuing is that we don't have to do that. We're buying them at a price, we're buying cash flowing properties, and we're able to do the conversion and be able to hit that affordability price point without having to get the incentives and the tax credits that are being offered. Now let me give you an example of one that we've acquired in the past 2 years. One of the first ones with Blackstone is in Sacramento, California. We've gone through the entitlement process to be able to convert that to a multifamily use. The market's still a strong market for hospitality. We have the opportunity to build a brand new Residence Inn, which is very exciting to Marriott to have a new Residence Inn, especially with this property being to where it needs a renovation. And as opposed to renovating it to a hotel, we'll renovate it and make it a multifamily property in a market that needs affordable housing. And we're excited to do that. So Rachel, as we look at this strategy, that is a great example of how we're taking the conversion strategy and making it so there's affordability housing in the market in the United States.
Great. Thank you, Cameron. Really excited to see this conversion in Sacramento. So, how do PEG's observations stack up against what the market data is currently showing? Here to answer that question is Rob Likes, Senior VP at KeyBank, who oversees that organization's attainable housing throughout the country. Rob.
Thanks, Rachel. Pleased to be with you today. I'm going to discuss the demand for attainable and affordable housing, and I'm going to use these words interchangeably throughout. We're going to take a deeper dive looking at 2 slides, looking at some data. We're going to discuss what's caused the attainable housing shortage and briefly mention the COVID impact as I wrap up. First off, the demand for affordable housing. One of the many challenges our country is facing is the affordable housing crisis, which impacts every state and every county. This results in a shortage in the millions across the nation. Taking a look at the first slide, there are approximately 330 million people in the United States, making up some 128 million households. Home ownership is near an all-time low of around 65%. The balance of the households, some 45 million, are renter households. So this is a very large population in our country of renter households. Nearly half of all renter households are cost burdened, meaning they're paying more than 30% of their income on housing, with over half of these severely cost burdened, meaning they're paying over 50% of their income on housing. Being cost burdened or severely cost burdened leaves limited resources for food, healthcare, education, transportation, etc. Affordable and attainable housing that you can afford leads to many positive outcomes for individuals, families, and communities. Moving over to the right-hand side of the slide, let me show you just a couple sample states of the shortage of housing. California, for example, is short nearly 1 million units for extremely low-income rental units. Arizona is short 134,000, Illinois 289,000, et cetera, et cetera. We can go through every single state and see that there is a major shortage. And this is just for the extremely low-income households that are earning 30% of the already median income. If you go to other low and moderate income households of, say, 50, 60, 80% of the already median income, workforce housing, et cetera, these gaps, these shortages, these numbers go way up. Skipping over to the next slide, this slide's called The Gap. I love the slide. It really shows the data extremely well for, again, the extremely low-income households making 30% AMI. You take a look at, for example, Colorado, there are only 31 affordable rental homes available for 100 households that need the rental housing. And you can look at every single state. There's a gap in every single state. And again, these numbers expand dramatically when you include other low and moderate income populations.
Rob, does KeyBank have any insight into what's causing the shortage?
The shortage has been caused by many factors. Let's just talk about a couple of them that have been going on for several years now. Construction costs and rents have increased at a much faster pace than individual and household incomes, putting attainable housing out of reach for many. And due to the high costs, most of the housing that's been built over the last decade has been luxury Class A. With construction costs so high, it is not economically feasible to build affordable housing without major subsidies, which are very limited. For example, the Low-Income Housing Tax Credit Program, otherwise known as the LIHTC program, which was created in 1986, extremely successful program, but there's very limited funds available. It only produces and preserves about 100,000 units of affordable housing per year, which is nowhere near enough to solve the affordable housing crisis in the country, which is in the millions and millions.
Thank you, Rob. So understanding the severity of this housing situation, PEG had embarked on a strategy back in 2018 to bring more attainable housing options to communities across the country while also delivering good investor returns. Cameron touched on this a little bit in the beginning, but to better understand the steps and what we're doing to make this particularly compelling to both renters and investors and communities, I want to bring in Soren Halliday, Chief Investment Officer of PEG Companies, who can describe the different steps and what we're doing in order to achieve this. Soren?
All right, thanks, Rachel. So Cameron talked about the general strategy that we have, and I have the privilege of talking to you about and telling you about the strategy in a more detailed nuts and bolts manner. First of all, there are essentially 6 different types of steps that we look at specifically when we're doing this process. This acquisition process really fits our company perfectly well, we believe, because of the fact that not only do we develop and acquire hotels, but we also develop and acquire multifamily assets. So because of the fact that we're hospitality and multifamily strong, this strategy fits perfectly with us. So how do we execute these 6 steps? Let me point you to a slide. Step number 1 is the acquisition and underwriting process. We have an extensive network of groups around the country feeding us opportunities such as brokers, lenders, existing owners, equity partners, current investors. We've reached out to the entire market, and we're actually receiving a number of these types of properties right now that we're currently underwriting. We also perform a rigorous underwriting of these assets. We not only look at the multifamily underwriting, but we also look at the hospitality underwriting should we have to hold these assets for a time as hotels. We look at stabilized unlevered yields and make sure they're commensurate with solid returns in the marketplace. We look at IRRs, and we also look at replacement costs. Our due diligence also consists of a thorough examination of the entitlement situation of each property. We talk with cities, local land use attorneys, whoever we can talk to understand the entitlement process for rezone, and we ensure that the property has an opportunity and the ability to be rezoned. Step number 2, the hotel operations. Should we acquire the property without having fully entitled the property just yet into multifamily, then we need to operate this property as a hotel. Fortunately for us, we have the expertise with our in-house management company, In-Group Hospitality, to understand the operations of the hotel and underwrite that properly. Step number 3 is the re-entitlement process. So like we mentioned before, this is a key component of our value-add strategy. And as you know, Cameron and Peg, we have extensive experience on the entitlement front with any city. We feel that's one of our key strengths. Step number 4 is the conversion process. During our due diligence, we do an extensive review of the property, ensuring that we understand what exactly needs to be done with regards to renovation work so that we can compete with the existing Class B product in the marketplace. We not only look at the hotel's existing bones, but we also examine other aspects of the property that will provide an opportunity to enhance returns. Step number 5 is the multifamily operations. As you know, PEG also has a multifamily operator. We manage approximately 3,000 units across the United States, so we have an extensive knowledge of the multifamily operations. So that not only helps on the underwriting side, but it gives significant comfort to banks and lenders that we can manage the property coming out of the renovation. Step number 6 is, last but not least, the disposal of the asset. So we will gauge the proper time in disposing of this asset based on certain market dynamics, cap rates, hold period, whatever it might be. Our asset management team is poised to ensure that the maximum profitability is achieved. So that was a quick version. Obviously, there's a lot more to it. And if you have any questions, you can actually use the comment box to ask those questions, and we'll get to those questions later. Right, Rachel?
Right, Soren. If you do have any questions, feel free to add them to the chat box, and we'll get to them at the end. While this strategy is actually quite unique, it's not like it's never been done before. We have a good example of a first-generation residence inn that was converted into an apartment complex here in Salt Lake City. For more on that case study, let's hear from Alex Murphy, Senior Investment Associate here at PEG Companies, who's actually been overseeing a lot of the modeling for this strategy here at PEG.
Thanks, Rachel. I'm standing in the parking lot of a former first-generation Marriott Residence Inn that in 2011 was acquired, re-entitled, converted, and is now known as 765 Lofts. It's a 128-unit multifamily apartment complex. Formerly, these units were built by Marriott to act as a garden-style apartments. As you'll see, each of these buildings is an 8-plex consisting of 6 studio apartments and 2 two-bedroom units. This apartment complex, in fact, in 2019 recently traded at a sub-5 cap rate and has been maintaining 95% occupancy over the last 9 years and demanding super high rents. In each unit, you'll find that there is a full-size kitchen, including a fridge, oven and stovetop, a dishwasher and microwave, and even a countertop with an island. There's plenty of kitchen space for storage and for your pantry. Additionally, there's a large bedroom and a bathroom and a living room with a fireplace inside. And as you can see, each of these units has its own private exterior entrance, providing renters with the privacy and convenience that they're seeking, especially during times like these with COVID-19. As for the renovations, when compared to the PIPs required by Hilton and Marriott on the hotels that we own and operate today, they're a lot easier. For example, on this property, the kitchen cabinets were refinished and repainted. The carpets and flooring were redone. There was an island added in the kitchen, and the units were repainted. There weren't any major renovations done on the interiors. On the exterior, these already include the amenities that renters are seeking today. There's a pool, a fitness room, office space, and even a lounge area that renters can hang out in and have a great multifamily experience. And Rachel, for these reasons, we believe that PEG's extended stay conversion strategy will be a huge success in the years to come.
Thanks, Alex. And again, as Cameron had mentioned, the majority of the hotels in our conversion portfolio are Marriott branded, but we are looking at other attractive acquisition opportunities across the different brands, including Hilton Home & Suites, Extended Stay America, and Hawthorne Suites, and we're really excited about taking the portfolio in that direction. Back in 2018, that first batch of hotels that we purchased in our portfolio are actually now starting to convert. And so how is that process going, and what are cities thinking about this? More to hear from that and more from that perspective is Denise Darling, Executive Director of Livable Buckhead out of Atlanta, where we actually own a first-generation residence inn, which just recently received entitlements and will begin conversion soon. Denise?
Great. Thank you, Rachel. I am so pleased to be here today to talk to you all a little bit about Buckhead. So as you mentioned, it is one of the places where you are getting started. And I think it might have been surprising how quickly and receptive the community was to the whole conversation. And to understand really why that's the case, you need to understand Buckhead. So we're a unique business market in the city of Atlanta. We're the northernmost business district in the community and the wealthiest. And like many markets, we started out really as a suburban sort of commercial hub with anchored by 2 malls and surrounded by high value single family development. And as the area densified, property values continued to skyrocket, land prices drove that. And, so we weren't getting a lot of housing that was developed in the mid-range of the market. And then on the flip side, you had on the employment side of that equation, we had a really different picture because we're characterized by a lot of retail and hospitality development. In fact, 30% of our development is in that sort of hospitality sector. So that means that we've got a lot of our workforce earning pretty modest incomes, and they're not available or not able to afford that high-end housing that is, the lion's share of what we have in the market. So, and because of that mismatch between the employment and our existing housing, we have a traffic problem. So 92% of our workforce commutes in every day from somewhere else. And what's even weirder is 92% also leaves the community. So we do a complete flip of our entire market every single day. And so that results in traffic. So we conducted that study, we dove into our housing, and what we found was that we had actually a capturable demand of 6,000 additional units. And this is in addition to everything that was in the pipeline. I probably should say it's pre-COVID, so who knows there. But the demand was essentially 6,000 units below market rate that we could absorb, as well as 6,000 units at market rate. So the market rate piece is going to take care of itself, but it's the other part. It's that the end that is in the below market rate, that we really need to add in additional housing and take some concerted steps to make sure that happens. And that's why we're so excited about the opportunity to put these units back in that mid-range, because what we found is we had stock on either end that was cannibalizing the middle. You typically hear about this missing middle when it comes to housing. We actually had that, but because we didn't have both of those ends of the equation taken care of, it literally, the people on the high end were buying down, the people on the low end were buying up. And so putting this new stock in that is right in that sweet spot is just an amazing thing for us. And the timing couldn't have been better for this conversation, because it was literally on the heels of us sharing our study results and starting to look for opportunities to develop these new types of housing at the midpoints we needed. And frankly, Buckhead is pretty well developed. It's pretty well built out. So, and the land prices don't make sense to build new Class B development. So taking approaches like the one that Peg is taking here with our Marriott Residence Inn is a fantastic way to really take our existing conditions and flip them into something that makes sense for the community. So couldn't have hit it at a better time. And that is really what helped make sure that the community was receptive to it and move forward and get the entitlements that were needed to make this property happen.
Thanks so much, Denise. Super appreciate that. So as we wrap up the presentation portion of this webinar, we really can't conclude without at least touching on COVID-19. So I want to circle back to Rob Likes of KeyBank. Rob, how do you anticipate the pandemic affecting affordable, attainable housing in the U.S.?
Thanks, Rachel. We've seen over the last couple of months the importance of housing in the world and in our country, and in individuals and families and households. It's very important. Unfortunately, with so many people losing their jobs or having reduced income as a result of COVID, the already acute housing crisis that we're in will unfortunately be going up. So the demand will be increasing dramatically.
Okay, that's exactly what we're seeing, which is why we're doing what we're doing. We're leveraging this current environment to provide really strong housing options for where it's most needed. Our COO, Rob Fetzer, has been the champion of positivity during this whole entire COVID-19 crisis, and I want to have him join the conversation and share some thoughts. I think most would agree that our conversion strategy that we started back off in 2018 is even more relevant now in this COVID-19 environment.
Yeah, great point, Rachel. Thanks for having me on. I'm excited to talk about this. We're excited here at PEG, just moving forward. In the pandemic, we've learned a few things, particularly that attainable housing is going to be a strong strategy moving forward. We're seeing the need for housing more and more so across the United States in many, many markets. And that's why we're so excited about this conversion strategy. We're going to take two of PEG's greatest strengths, hospitality and multifamily, and combine them into one strategy to provide attainable housing. It's not just about the affordable housing or the attainable housing and this strategy, though, here at PEG. We're full of optimism about the marketplace in general. PEG has always focused on market fundamentals in all of our projects. Those market fundamentals really create the best opportunities and the best projects in any marketplace. So we're going to focus on those. And it's really interesting because the markets that we focus on really are the ones that have those fundamental economic indicators that were leading prior to the pandemic. Moody's Analytics put out a report just a few weeks ago about predicting the 10 best cities that are going to emerge from this economic downturn. They also ironically listed the 10 worst, but we're going to focus on the 10 best because we're all about positivity around here. And of those, two of the leading ones were Denver and Salt Lake City. And Salt Lake is one of our main hubs where we produce product. And Denver, we've got a project that we're looking at in there. And then also included in the 10 are Boise, where we have assets now and new developments proceeding. Provo, Utah, which is our home base, it's where our offices are. And we have several blocks that are under development with housing. And we just opened a hotel and office that's moving forward in there. And Tucson, Arizona, which is a growing area out of Arizona. And we're excited to be working on housing down there. Even entering into 2020, Rachel, we saw market fundamentals shifting in hospitality already, and we moved quickly to downsize the amount of new development in our portfolio for select service hospitality, and instead focused on high barrier to entry areas where we knew hospitality was still underserved and could provide great returns. And we're continuing to push forward with several of those opportunities. And you'll see those as we roll out our investment packets. We will focus on dynamic resort or economic centers to bring forth other hospitality, and we'll see how those play out over the coming recovery. But the early indicators are that they'll play out strong. Most of all, Rachel, we want to be that partner that investors are excited to partner with. We have an excited team who are positive and moving forward, working hard day in, day out, despite the COVID-19 pandemic. We know that positive attitude coupled with hard work will create opportunities because we did it in the last downturn and we know we can do it in this downturn.
Okay, thanks, Rob. So that wraps up the presentation portion of today's webinar. We have some questions that have come in, so we've invited Soren Halliday, our Chief Investment Officer, to join me to answer some of the questions that we've got in. If you have anything, please add it to the chat box and we'll try to get to them. We'll spend the next few minutes. Let's see here. I've had a couple questions come in about the markets that we are looking at going into and markets that we may not consider. Soren, can you answer that?
Yeah, I'd be happy to. So we're actually looking nationwide for these properties. We're not only looking at Marriott's or Hilton's or Hyatt's or IHG kind of big brands, but there's also a number of other brands of extended stay hospitality properties that are out in the markets. So these are nationwide. The kind of markets we're actually specifically not focusing on, we're not looking at extreme tertiary markets where the population is really not considered an MSA, which is about 60,000 people. So we're actually looking at those larger MSAs, any MSA that's 60,000 or more. But even within those markets, we're looking specifically at the location of the hotel. Where is it located? Is it near a freeway? Are the access points good? Are they near what we call high energy centers, like locations of interest for people, where people want to be? So within those markets nationwide that we're looking at, we're actually even narrowing down and zeroing in on the specific location of the hotel within that market.
Okay, great. Thank you. Let's see here. Next question is about the competitive landscape. I think I can start this one off. I've spoken with several groups over the last couple of weeks, and we know that there are groups out there that have completed conversions across the country. There's not like a ton of them out there, but we definitely have seen some good ones, one here in Salt Lake, one in Houston, some others. And in my discussions, we're hearing that we actually have thought through this strategy quite well. We've been doing this since 2018, and we've learned a lot from our first few acquisitions. But we've also thought through, we know that the entitlement portion it can be challenging. We want to be really selective on the types of properties that we select. But in terms of a plan, also if hotels can't be converted, what would we do? I've heard feedback that we've actually thought through this quite a bit, but I don't know of anyone doing it in sort of the aggressive and very large way that I feel like Peg is doing it. And I don't know, would you agree? Or?
Yeah, I mean, I've heard the same. We're talking to the brokerage communities every day. We're talking to the other parties like that every day. And it's very similar. I think right now you're seeing a lot more groups that are trying to figure out what to do in this new world, right? And they're all, I shouldn't say all, but there's a good number of people that are now jumping into this. I'll talk to a broker every day. They'll say, I've had several calls from different groups who are trying to do the same thing. But it all comes back to the fact that you guys PEG is much further along in the thought process. Yeah. You've already transacted on assets, even though we haven't specifically converted any yet.
But we will.
We will. We have the whole plan to do that. We have the team to do that. Hospitality, multifamily, like I mentioned before, and we also have just that knowledge, know-how, and strategy. We've already re-entitled several properties, so we know that whole process. We're much further along the process in that, and we know the specific questions to ask when we're talking to the cities. We know the specific information we need, not only on the multifamily, but on the hospitality side from the broker. So we're ready. When someone brings us a property, we can turn around that analysis pretty quick, and so the brokers actually really like that.
Okay. So we've had a couple questions come through regarding entitlements. So I think they're asking, it does seem like they're wanting to know, what challenges are you seeing with entitlements? Like, how do you address that? Yeah, let's tackle that one first, because I think we've had a few questions come through about that.
Okay, great. Yeah, it's always one of the first things that we look at,
Yeah.
because obviously every city has hotels, and well, I shouldn't say every city, but most cities have hotels and apartment properties, and they're typically always zoned differently, right? Different uses. So some of the challenges that we're running into with regards to entitlements, if it's a city that basically tells us, you know what, we just can't do it because of X, Y, and Z, then we stop it there. We don't look any further. There are some times where maybe some of the runway might be a little bit lengthy enough where we will look at it and maybe acquire the property if we can operate it as a hotel for a certain period of time and cash flow really well. Mm-hmm. That's really what we did on our first couple of portfolios that we acquired. But this is a slightly different environment. So right now we're actually really focused on immediate conversion opportunities where we can receive the entitlements within 4 to 6 months and actually be in a due diligence process during that time, just because of financing is very difficult for hotels right now. So we see that there is a lot of interest in the financing side for multifamily. So, again, going back to the question, entitlements, what are challenges? Parking's a challenge. Typically hotels are on a parking ratio of about 1-to-1. In most cities, parking ratios are required to be more. But we tackle that in several different ways. We do parking studies. We're able to talk with cities and help them understand what the size of the units and what the type of units are at the hotel. Not necessarily 2 bedrooms or bigger units, but we have these small units that are usually for a business professional, a couple, whatever, the smaller type of family. Landscaping requirements. Sometimes there's conditional use things. So every city, it's different with every city. And we work with land use attorneys. There are some cities where you don't even really have to work with land use attorneys. We can actually have the expertise in-house that we can go in and do the re-entitlements. But yeah, that's a challenge, and that's one of those things that gives us the competitive advantage, we think, because we've done it before. We're very comfortable doing entitlements with everything that we've done. And so a lot of people, current owners of hotels who are thinking about it, they get scared away. Other groups that don't have the experience like we have get scared away because of that risk. But, it's something that we're comfortable with.
Yeah, no, it's great. Another question is about, does this strategy rely on having the hotelier like Marriott looking to build a new hotel? And this is pretty easy, but early on, we actually were really excited about building the replacement properties so that we could get released from the license on the older property. And that was our strategy going in. But now, as Soren mentioned, we are looking for hotels that are unencumbered and we can convert immediately. So no, there is no requirement on the strategy.
Let me just add to that, Rachel. Our first few transactions were along those lines of we were going to convert and have a new hotel, which worked out perfectly for us, right? We're a development company, and this conversion works out great. Now, ideally, that would be a great scenario for every property, but in this environment right now, with the hotel world kind of on its heels, we're kind of thinking elsewhere, and that strategy, the immediate conversion strategy, has been really good. Yep. So we do have to take into consideration that there are franchise fees that we have to look at, and franchise terms on some of these hotels. Yeah. So we definitely take that into consideration. Sometimes you have to break those, and so we look at those costs. But we have great relationships with a lot of the hotel brands that are out there, and so we work through those things. And sometimes those hotel brands are willing to negotiate with us right now on liquidated damage fees. or whatnot. So that's another part of our due diligence that we really take into consideration.
Yeah, no, that's great. Okay, here's another question. It's can you give a specific illustration of the value-added elements of the strategy? So meaning, what are the estimated all-in costs per door, including the acquisition and renovation costs, versus the current market values that we're seeing out there?
So that's good. So it really depends by the hotel. One of the things that we really look at in each market is the replacement cost. So if we're all in on our project, whether it's the acquisition plus renovation costs plus other soft costs, whatever it might be, we look at what's actually happening in those markets and where
Right.
properties are transacting on a per door basis, and we compare that to our all-in cost. Now, like Alex said about the property in Salt Lake, our renovations are pretty much, we're trying to compare ourselves to the Class B market, so we do an in-depth analysis on that Class B market, and we look to see what type of finishes are in this Class B market. So, and these hotels come to us in all different shapes and sizes. And we have a
Right.
hotel right now we're looking at putting in over $20,000 a key on renovation. We have a hotel right now we're looking at $5,000 a
Right.
key.
Far less.
So our purchase price on that lower cost per door renovation, the purchase price of the hotel can be a little bit higher when you compare it to the market, right?
Yeah.
So that we go in, we do a thorough analysis with our construction team as well, and we go through and we try to figure out what exactly does this hotel need. And because of our experience on the property improvement plans that we do on hotels and our development and acquisition experience, we can easily go in and assess what needs to happen and what those costs are.
Yeah, no, it's super smart. I like that. Okay, so another question is COVID impact on acquisition. So we're starting to see that, and I know the buzzword out there is distress, distress, distress. Could you comment on what you're seeing in terms of the impact on acquisitions and availability of,
So this strategy that we have actually puts us in a really unique position because the hotel acquisition market has just completely caved in, and there are only a few. Well, the amount of individuals out there in groups that can transact without lender financing to buy a hotel, they're a lot fewer today than they were in the past. So you have our group being able to come in and say, well, we don't have to transact on a hotel. If we can do an immediate conversion, we can acquire this property as a multifamily property, and there are other financing options for us out there. So sellers have actually really liked that. And in some instances where we have significantly depressed pricings, especially in this COVID environment, you're not seeing a large number of sellers reducing their pricing right now. There's just not that. The reality
Right,
hasn't
not
set
so
in.
much yet,
They've
yeah.
still kind of been floated along with government aid. So we're able to immediately come in and say, hey, here's the price that we can get because of the strategy we have, and it might even be a little bit higher than a distressed pricing. Now, our pricing distressed, and we're getting really good deals. Again, it all depends on the market analysis that we do. So we're actually comparing against the multifamily market, which in most markets has still been fairly strong.
yeah.
So we have a whole different way of looking at the hotel, and a lot of times that gives us the advantage on the market. So how's that?
Yeah, no, that's great. And again, I think in a few months down the road, it'll change and it'll be different. But right now,
Yep.
the nice thing is we're seeing good prices, so that's good. Question that just came in: are any of these projects in ozone locations? No, even
Yeah.
if they are, we're not necessarily.
And again,
We should talk about hold period.
Yeah, well, for the opportunity zone locations, most of them are not, because most of these properties are in areas that have already kind of had that vitalization, right? And so, but if one does come in an opportunity zone, then we have to look at the amount of dollars we're actually putting into the redevelopment and the enhancement of the property. So you have to put in a big chunk. And then we also have to look at hold period. So it depends on our strategy. It depends on the investor group that is invested in that property. But if something's in an opportunity zone, will we not look at it? No, we will definitely look at it and look at the
Right.
different opportunities the investment opportunity there.
Okay, great. Well, this is a good question, and I can start on this one. But with financing being very tight right now for the hospitality sector, what buckets of capital do you plan to pull from? So, so we are actually, we are looking at, finding LP capital, and we've got some good partners as well, but we do believe that we can get debt, and the debt market is continuing to open up as time goes on. We understand that if there's another large flare-up, outbreak, whatever you want to call it, that things could change. But we are looking, we're raising this through our LP investors and looking for traditional debt and maybe some other types of debt as well. But we're actually not too concerned because it's the Class B multifamily housing that's actually being underwritten, and that's really what we're financing versus a hotel.
Yep.
So
yeah, I think it's more advantageous for us with our immediate conversion strategy on these hotels that we're looking at right now than it would be for a hotel.
okay. I think that's kind of wrapping it up. So anyway, we've enjoyed, this is our first webinar, so we appreciate you joining us today. We are going to post this on our YouTube channel, Peg Companies. And if you have any questions for myself or for Soren or for anyone and thank you to our guest speakers, Rob Likes and Denise from Buckhead. Thank you so much. We appreciate you joining us and participating. So if there are any follow-on questions, please feel free to reach out to us. And in the meantime, please stay safe and healthy, and we look forward to seeing you again. Thanks, everyone.